During the week of November 17th to 21st, 2025, Bitcoin ETFs recorded a historic trading volume of $40 billion, a milestone that, in prior cycles, would have been celebrated as an unequivocal sign of institutional strength and confidence in the asset. This time, however, the record carries the opposite meaning. It does not reflect inflows, but a mass exodus of capital. Detailed flow analyses reveal that the overwhelming majority of transactions consisted of withdrawals and redemptions, not new allocations. This shift marks a critical rupture with the dynamics that have supported the market since the approval of spot Bitcoin ETFs in January 2024. At the epicenter of this reversal is BlackRock's iShares, Bitcoin Trust's IBIT, the world's largest Bitcoin ETF. Alone, the fund accounted for $27.79 billion in volume that week, nearly 70% of the total, but almost all of it represented net outflows, not inflows. Year-to-date in November, EBIT has already recorded losses exceeding $1.26 billion, confirming that this liquidity surge was driven not by demand, but by strategic divestment from major players. On Friday, November 21st alone, ETFs moved $11.01 billion, coinciding with Bitcoin's drop into the $80,000 range, its lowest level since the start of the year and the weakest price of 2025. This reversal of flows carries profound implications. Throughout much of 2024 and early 2025, Bitcoin ETFs acted as structural demand anchors, consistently absorbing institutional capital and cushioning short-term corrections. Each new volume record was interpreted as validation of BTC as a legitimate store of value, pushing prices higher and attracting new participants. Now, however, ETFs have ceased to function as a floor and instead serve as an exit valve, a channel through which both institutional and retail investors lock in profits or reduce exposure amid uncertainty. The drivers behind this capital flight are multifaceted, but to stand out, first is the coordinated movement of us long-term Bitcoin holders, who in recent weeks have transferred billions of dollars worth of BTC to centralized exchanges, signaling large-scale profit-taking. This behavior, tracked by platforms like Look and Chain, has triggered a cascade of pessimism, especially among institutional investors who interpret such movements as a sign of a market top. Second is the ambiguous macroeconomic environment. Despite recent rate cuts, the Federal Reserve has signaled a pause in its easing cycle, while geopolitical tensions and weak labor data have reinforced demand for safe haven assets like the US dollar and treasury bonds at the expense of risk assets, including cryptocurrencies. The most significant consequence of this new dynamic is the collapse of a core psychological pillar of the modern crypto market. The belief that ETFs would guarantee a permanent base of demand capable of supporting prices even during volatility. It's now clear that ETFs are mirrors of institutional sentiment, not unconditional magnets for capital. When consensus shifts, they amplify outflows, just as they once amplified inflows. Moreover, this record volume amid a sharp price decline exposes a structural vulnerability: Bitcoin's increasing dependence on the psychology of net flows. Not just total assets under management (OM). Even though ETF OM remains high above $150 billion, the speed and direction of daily flows have become more sensitive indicators than the accumulated stochastically in a highly leveraged, news-driven market. A crucial question now remains: is this new dynamic temporary, or does it signal a permanent regime shift? In summary, the $40 billion volume record is not a sign of strength, it's a warning signal. It demonstrates that even the most regulated and institutionalized instruments in the crypto ecosystem are not immune to the market's cyclical laws: euphoria, distribution, disbelief, and, eventually, capitulation. If December brings macroeconomic stabilization and a return of positive flows, BTC could rebound quickly. But for now, this historic record serves as a reminder that volume alone doesn't dictate direction. What matters is who's buying and who's selling. And in November 2025, the sellers are clearly in control.